Hey, welcome to Dow Stock Talk, where I talk about topics relating to investing and finance, but more specifically, the stock market. On this video, I'll be doing a stock analysis on Target. I'll be going over the company's overview, the streams of income, competitive advantage, the competitors, the risk factor, the financials, and last but not least, whether I think Target is a good buy. But before we get started, make sure you smash the like button because it helps the YouTube algorithm. It helps you know that this is quality content and help my videos reach a broader audience. And by the way, if you're a big fan of finance and investing t-shirts, make sure you check out my store, Wall Street Stock Apparel, where I make custom finance and investing t-shirts. Now let's jump into it. I'm pretty sure a lot of you guys already heard of Target, but I'm just going to do a brief overview of Target. So Target is a retail store where they pretty much sell everything you can think about, from kitchenware, clothes, toys, furniture, hardware, electronics, everything you can pretty much think about. They're the 8th largest retail in the United States, and they have 1,900 plus stores. Now let's go over the streams of income. So if you can see, for the total sales for 2020, 26% came from beauty and household essentials, 20% came from food and beverages, 20% come from home furniture, 16% came from apparel and accessories, and 18% came from hard lines. Okay, so now let's go over some of their competitive advantages. One is their brand is recognized and they have a lot of customers. It's one of the well-known retailers out there. They do sell similar stuff to like Walmart, but as far as Target, as far as customer service and logistics of the store and how it's set up, in an environment, it's a lot more, I guess, when I consider as far as a better quality. A lot of times they are associated with nice quality Target, and a lot of times their customers are considered pretty loyal. And also I consider it's one of the top brick and mortars in retail, as far as it has a long established history. They're known to have quality products, as well as the store layout and stuff is pretty nice, and a lot of people are familiar with it. So those are some of the competitive advantages. Now, as you can see, let's check out that competition of other companies that they would have to kind of compete against. So I would say some of their competitors, I would say Walmart, Costco's, TJ Maxx, and I would even definitely say Amazon, simply because a lot of people are buying online. So they will have to compete against a lot of online stores as well. As far as, retail, we've seen a decline over the years. It may pick up a little bit, but I think for the long run, I definitely think they're going to have to compete against a lot more online stores. I definitely just wanted to mention that. Now, speaking of that, now let's go into risk factors as well. One of them could just be simply changing customer demand. As time goes on, customers' appeal may be somewhat different. So if there is any type of change as far as the customer loyalty, they decide to go with other online stores and stuff, that could bring up a problem. But another thing is, it's a lot more competition on the with online stores. So a lot of people are buying online now, so they have to be very competitive in the online space as well. And last but not least, one of the risk factors that they might have to face is hacking. One time Target did get hacked before, and some information was from their customers, got into the wrong hands. If this particularly happens again, that could definitely tarnish the brand and make Target less trustworthy, or it could definitely damage their brand. Okay, so let's briefly look at the revenue and earnings. As you can see, for 2018, 2019, 2020, and 2021, we did see an increase in revenue as well as it looks in earnings. As you can see, for 2018, the revenue was $72 billion. The earnings was $2.9 billion. For 2019, we see an increase to $75 billion, $2.94 billion in earnings. For 2020, we've seen $28 billion and $3.28 billion. And for 2021, as you can see, we have let me roll it down a little bit, $93 billion, and for the earnings, we have $437 billion. So we did see an increase in earnings and revenue, so that is definitely something you would like to see. And also, as you can see, for the last quarters, quarter 3, quarter 4, 1, and 2, they have beat estimates. That is always good to see. Now let's check out the other financials on Simply Wall Street. So now let's check out the share price. So currently, as of June 21st, the share price is $233.77. I like a lot of times I just like to look at the 5-year chart just to see how it has been increasing. And as you can see, it has been increasing nicely. So that is always good to see. Now let's just jump into the validation. So this is, according to Simply Wall Street, what they value the company when they do the discounted cash flow model. I just wanted to let you guys know that some of these are, you have to put in a lot of assumptions. So everyone's might be a little different. So I just kind of look at this just to get a range. Normally, if you're a value investor and you're looking for bargains, you want to find undervalued companies. But this is just if you use a value investing strategy. As you can see, according to Simply Wall Street, they have as the current price $233.77. And they have the fair value, what they think the fair value will be based off of future cash flows, will be $258.03. So right now they're saying it's a little undervalued. So if you're a value investor, like I said, that could be a good thing. And also what I normally do, I normally check various sites as well just to see what their intrinsic value is or their discounted cash flow. So just to give me an idea, because each site is going to say something different. But I checked out of most of the sites, a lot of them that say it's near fair value. So I think once you have like a large census, everyone agrees on the same thing. I think it's pretty accurate. But let's check on the future growth. So the future growth they have for forecasted annual earnings growth, they have 1.2. That is very low for me, and this is according to 21 analysis. It says 1.2 forecasted annual growth for next 1 to 3 years. I think that is really low. And if that's actually true, I would definitely be a little concerned because that is really low. However, I did check other platforms and I got a mixed range from all the way up to 1.2 to 10%. But when I looked at it, I think a more accurate projection of this probably would be like more so 5 or 6%. But it's kind of hard to say. Future growth there, based off the analysts and stuff. So that can always change. As you can see, the revenue is in the blue, the earnings is in the green. As you can see, the free cash flow. So it seems like it's pretty decent. As you can see, we have the revenue increasing and we also have the earnings increase. We do see a slight fall off on the free cash flow. Free cash flow is meaning how much money is coming in after all the operating costs and stuff like that. We do see a decline in free cash flow. That's something you want to keep in mind. If we look at the past performance historically, the annual earnings growth was 8.9. Let's go back to the future growth. Now they saying and the future growth is 1.2. So as you can see, compared to past historics, that is a big difference. And like I said, I think that a more accurate one when I kind of looked at various other sites may be a 5 or 6%. Okay, now let's go to the financial health. As you can see in this one, that financial health is pretty good. Assets cover the short-term and long-term liability. So from a financial perspective, they seem to be doing pretty well. But let's look a little deeper. As you can see here, they have the red is in the debt. As you can see, they do have a lot of debt. Now, you also got to keep in mind that with how much debt the sector has. Now, I think I'm not exactly sure about this sector, but too much. But I think as far as retail or something like that, I think the amount of debt is a little higher. But I definitely would like to see the equity higher than the debt. In general. But as you can see, the debt right here in the later years, as you can see, the equity is higher than the debt. But the debt thing, as far as that, you just kind of got to keep an eye on. As you can see, the green is in cash. So the cash has been increasing. So if you have a lot of debt, I would also like to see them having a lot of cash, which they did right there, which is a good thing. As you can see, they mentioned that the debt to equity ratio is considered high. However, as you can see, even though the debt has been high, as far as paying their debt coverage, interest coverage, they seem fairly well. As you can see in the balance sheet, it seems pretty good. The only thing about it is the debt is a little bit too high for my likings, but it's okay. Now, as you can see for the dividend, the current dividend is 1.54%. I mean, it's okay. Sometimes I'm used to seeing a lot higher dividend, but like I said, it's okay. If you wanted to compare relative to the the market top 25%, United States 3.4, but in the market bottom, so at least it is above the market bottom. And as you can see, it's slightly above the industry, which is also a good thing. Which is also a good thing. So the thing is, if you're looking at it from a dividend play, there are dividends that pay a higher yield, But if you want to look at it, as you can see, they do have stable dividend in the past 10 years and growing dividend. So if you was looking for a dividend growth play and looking for a solid company or something like that, this could be a potential option to you. And as you can see, let's scroll down to management. As you can see, the management does have experience, which is also a good thing. But I like to also look at the ownership. As you can see, lately there has been a sell-off as far as insider trading stuff like that. If I'm a long-term investor, I don't focus too much on it, but it is good to see. It is good to pay attention to what is happening with inside trading, especially if you're a trader or something like that. But if you're looking at it from an investment perspective and you're looking at it from the business alone, I wouldn't put too much emphasis on it, but it is good to see if there's any inside trading going on, because it could suggest some type of stress or the strain, but I wouldn't, speculate that on that too much. So if we look at the 1 year return, it's up 90% compared to its industry, which is US multi-line retail, which is up 52% versus the US market. So lately it has been doing pretty well. That's always good to see. If you want to look at some of the metrics, as you can see, like I said, with these ratios, I like to compare it to the industry. As you can see, it's about the same price as its industry, so it's not lower. So I mean, it's what I consider fair. It is have a lower P over E ratio than the market, but only by a little bit. And just to give you a heads up, normally if the P over E ratio is lower, it could suggest that it's more of a bargain. Price to earnings growth ratio, it is considered poor, but like I said, these are just metrics that you can assess. Assess the business. As you can see, the price to book, you have you have the target, which is 7.8, and you have the industry, which is 3.2. So the book value of the industry is much better than targets. That's also something you may want to pay attention to. As you can see, I'm kind of skipping around, but the analyst forecast growth, you definitely want to pay attention to this because it's saying target is 1.2 and the industry is 6.6. If this is correct, I'll be very concerned about that. As well as the forecast earnings revenue growth, it's definitely saying that the industry is expected to have a higher growth rate in earnings and revenue according to analysts. This is analysts, but if these numbers are correct, I would be definitely concerned. But I honestly think it probably would keep up with the industry 5 or 6, looking at other sites and stuff like that. But this is where you have to do a lot more research to kind of figure out what do you think the growth of Target would be. Also, let's look at the earnings per share growth. As you can see, the earnings per share growth seems to, from 2020 to 2021, probably because of the pandemic and all, seems to be a nice increase. And it does seem like, as far as the earnings per share growth, it does seem pretty healthy. Also, if you consider the future returns on equity is 29.8, which is very high compared to its industry is 19.8. So if the growth isn't, the future growth isn't there, the fact that they got a high return on equity is something good to see. As you can see, the returns on the assets and the returns on capital employed, the company has a higher percentage of return for capital return on assets and return on capital employed. Now, to give you my personal opinion, I think it is a okay choice, but I would not invest in it because I think there's other better companies out there. Now, if you are a person who shops at Target and you really like the company, investing in Target, I would say it's not a bad thing, I think they will do well, but I feel like there's other companies out there that would give you a much higher return relative to the risk, especially looking at the growth rate and stuff that we've seen earlier. I'm personally not invested in it, but I do think it's an okay investment. But let me know in the comments below, what do you think? And also let me know if you like the webcam format or versus me sitting on the couch. But if you haven't already, make sure you hit the like button. If you're new, make sure you subscribe to my channel. Also, if you would like me to do any stock analysis or any other company, make sure you drop in the comments below.